Back in January, I began buying Spotify stock. Since then, Spotify stock price is down over 22%, and the stock just fell over 12% in a single day after reporting earnings. So is Spotify stock still a massive opportunity, or will it continue to crash? I'm about to show you why the stock crashed, then I'll break down what the company's management said in their earnings call, and at the end, I'll reveal my updated valuation model for Spotify stock. Since the start of 2026, Spotify stock is one of the worst performers in my portfolio, down 23%, and it's down over 43% from its all-time high. So what caused the stock to sell off? Well, on January 15th, Spotify announced they'd be raising their US premium subscription price. To me, this looked bullish, reinforcing my thesis that Spotify has strong pricing power. But the market didn't really seem to care as the stock continued to fall, hitting a low of $415 per share. Then on February 10th, Spotify released Q4 earnings. They reported strong user growth up 11% year over year to 751 million. And the stock had its best day since 2019, rising 15% to $475 per share, hitting a high point of $565 per share on March 6th. However, on April 28th, Spotify released their Q1 2026 earnings. The company beat expectations, but their guidance for future growth disappointed investors. This caused Spotify stock to fall 12% in a single day to just $435 per share. So we're going to look at Spotify's recent earnings call to see what actually happened inside the business and determine whether the stock is still a massive opportunity for investors. And then at the end, I'll show you my updated valuation model for Spotify stock. First, management gave an overview of Spotify's performance this quarter. Strong start to 2026 with Q1 performance at or above expectations across monthly active users, subscribers, revenue, and margins. Monthly active users reached 761 million, up 10 million quarter over quarter, beating guidance by 2 million. Growth accelerated to 12% year over year. Premium subscribers reached 293 million, up 3 million quarter over quarter, in line with guidance. Second highest gross margin ever in company history, reinforcing confidence in sustained growth, low churn, and improving profitability. Management positions this period as the beginning of a next chapter for Spotify, with more detail promised at the May 21st Investor Day. So from first impressions, this looked to me like a great quarter for Spotify. The 12% monthly active user growth was particularly impressive. With nearly 800 million users, it seems impossible for them to continue growth at this pace, but they're proving the doubters wrong. As a Spotify premium user myself, I've noticed them pushing referrals heavily. They'll show you an offer to send your friend or family member a 3 or 4 month free trial. This might seem like they're struggling to acquire users, but it's actually genius. The only cost for acquiring that user is the 3 months of Spotify Premium that they're giving away for free. But unless they made that offer, that person may never have entered the Spotify ecosystem. Then we get some details about how Spotify engages and retains users. Engagement is described as the lifeblood of Spotify. Key retention levers are more days active per month, more devices used, more content types, verticals consumed, music, podcasts, audiobooks, and now more video fitness. Global rollout of the more personalized free experience, especially in key markets like the US, is driving higher days per month usage. Enhanced free tier has created a clear step change in engagement versus historical trends, which management expects to translate into higher free to paid conversion and stronger lifetime value over time. Management prioritizes more active days in a month, even over more hours per day, as a better predictor of retention and value. So you can see Spotify's freemium business model in full effect. They focus their efforts heavily on increasing the rate of free users who convert to premium members. And management actually goes into more detail about their free tier strategy. The upgraded, more personalized free tier is performing better than internal expectations, with significantly higher engagement and satisfaction. Q1 ad-supported gross margin was pressured because rising engagement increased content costs faster than ad monetization. This is explicitly characterized as a short-term effect. Leadership expects that as the rebuilt ad stack scales, rising engagement on free will translate into better monetization and gross margin tailwinds in later quarters. So as with most freemium-based businesses, they show ads to users, and Spotify's advertising revenue has historically been quite underwhelming. However, over the past few quarters, management has been highlighting their new ad stack. This could suggest that management believe advertising revenue will be more meaningful in future. Their management talks about their AI strategy. AI and machine learning have been core to Spotify for years. Current advances are described as a step change in what the tech can do for personalization and product development speed. Spotify is integrating AI across the company to accelerate product shipping, more features faster at lower cost per feature, deepen personalization, your Spotify your way, move from passive recommendation to interactive, user-steered experiences. Large personalization model, taste model, is trained on proprietary behavioral data from 0.75 billion users. Leadership views this as a key differentiated asset that cannot be easily replicated or rented. AI usage is increasing operating expenses mainly via compute, not headcount, but management cites strong productivity gains and engagement metrics as justification. I think the most interesting point here is that Spotify is using data from its 0.75 billion users to implement AI more effectively than competitors. At the end of the day, software and especially consumer-facing apps rely heavily on data to show them how to improve their product. And Spotify has more data than Apple Music, Amazon Music, and any other challenger. This data advantage will help Spotify extend their competitive lead in the age of AI. Then we get detail on some specific AI-driven features. AI DJ, IDJ, now used by 94 million subscribers, approaching 100 million, and driving billions of hours of engagement. Song DNA and About the Song, launched this quarter, offer deep context on tracks and creators. Song DNA reached 52 million users in just 4 weeks. Taste Profile Beta lets users directly view and edit how Spotify models their listening, e.g. include, exclude specific artists, add a classical tab, giving users a new level of control over personalization. Prompted playlists allow users to create playlists via natural language prompts, now extending beyond music into podcasts. Goal is a shift from Spotify purely recommending to users co-steering and shaping the experience. Single player to multiplayer, interactive media consumption. So it seems these AI-driven features are gaining adoption amongst a large portion of Spotify users. Personally, I haven't really tried any of these features. I've seen Song DNA pop up, but it doesn't really affect my experience in any way. Then we have more new features. Features like Jam, Blend, Messaging, Mixing, and Wrapped Party are building out the multiplayer side of Spotify. Jam usage has doubled year over year and now exceeds 100 million monthly listening hours. Management sees these social multiplayer features as early evidence of an interactive multiplayer Spotify that will be built on further. So it seems Spotify are trying to make their product more socially driven. Again, I'm sure there's some utility to these features, but I haven't used any. Their management discusses their AI-generated music strategy. Spotify sees generative AI in music as twofold. Net new music, greatly expanding the catalog, good for aggregators, and makes recommendation more critical. Derivatives of existing music IP, where existing artists and rights holders are currently largely left out. Spotify wants to focus on solving the harder problem, enabling derivatives of existing IP in a way that addresses copyright and attribution so existing creators can participate and benefit. Management emphasizes they already have the technological and data capabilities to pursue this, and see it as a large opportunity for both new and existing creators. If Spotify owns the rights to AI-generated music on their platform, it would produce higher margin revenue than authentic music, because Spotify has to pay labels and artists for streaming their music on the platform. With Spotify's own AI-generated music, the only cost is the music production. The rest is pure profit. Then we get Spotify's response to investor fears around AI disruption. Key advantages cited: nearly 20 years of listening data across hundreds of millions of users, enabling a unique taste graph that is constantly refreshed as culture changes. In-house, large personalization models trained on proprietary data rather than rented generic models. Scale: needs tens, hundreds of millions of active users for models to remain relevant as tastes shift weekly. On AI disruption risks: free AI music, AI-first competitors, large tech platforms. Management distinguishes Western markets, content not gated between free and paid, from markets like China, where AI challenges content gating. Spotify's model is not based on gating catalog access, reducing that specific risk. Belief that personalization, taste modeling is much less easily commoditized than factual knowledge. So like I mentioned before, Spotify will use its huge scale-driven data advantage to remain ahead of its competitors. I'd also like to highlight that Spotify has its own in-house AI models trained on their proprietary data. This is data that only Spotify has access to. Then we get onto Spotify's recently announced partnership with Peloton. Spotify already sees strong organic fitness and wellness behavior. 70% of premium users work out monthly. Users have created over 150 million workout-related playlists with growing use of prompted playlists. New Fitness Hub launched as a dedicated service for fitness content. Peloton partnership. Peloton's premium subscriber content is now available within Spotify's Fitness Hub in an ad-free format for premium users. Management describes it as high quality, typically higher priced subscription content brought into premium. Structurally likened to audiobooks and the Spotify Partner Program, premium partner-produced content delivered ad-free inside the existing subscription. Fitness is framed as an expansion of an existing organic use case, not a new category from scratch, and a good fit for video usage, including on TV screens. I can confirm Spotify's utility during a workout. Whenever I go for a long walk or lift weights, my Spotify playlist is always running in the background. Spotify then give more detail on their previously mentioned advertising business. Over the past 1.5 to 2 years, Spotify rebuilt its ad tech stack end-to-end to participate better in biddable programmatic TAM. This decision introduced near-term pressure but is seen as unlocking a much larger long-term opportunity. Biddable automated channels now represent more than 1/3 of ad revenue and are growing quickly. Legacy direct sales channel is still choppy and a source of near-term volatility. Rebuilt stack allows better participation in programmatic and biddable markets, new ad products and formats that weren't possible on the legacy stack, improved measurement and performance reporting. Advertisers' core reasons to use Spotify are unchanged: a beloved brand, high user engagement, and high quality content. Management reiterates that improved advertising growth is expected to show more clearly in the second half of 2026 as biddable channels scale and the free tier engagement is better monetized. So like I mentioned earlier in the video, Spotify has laid the foundation for profitable growth in their advertising business. Let's hope to see some big results in the next 12 months. Then we get a deeper dive into Spotify's financial performance and margins. Q1 2026, 4.5 billion euros, up 14% year over year, accelerating from 13% in Q4. Premium revenue up 15% year over year, driven by subscriber growth and ARPU expansion of 5.7% year over year. Ad-supported revenue up 3% year over year, with automated biddable channel now greater than 30% of ad revenue and growing fast, but legacy direct sales still uneven. Gross margin 33%, 20 basis points above guidance, and 133 basis points higher year over year, driven by revenue mix and lower other cost of revenue. Operating income 715 million euros, 55 million euros above guidance. Operating margin 15.8%. Outperformance largely from lower social charges. 49 million euro benefit from share price movements. Excluding that, operations were still 6 million euros above guidance due to higher gross margin. Free cash flow 824 million euros, stronger than typical Q1 due to timing effects expected to reverse in Q2. I suspect that 5.7% increase in average revenue per user would have come from their subscription price increase. Pretty solid performance all round. Then we've got Spotify's capital allocation strategy. As shareholders, this is particularly important because it tells us what the company is doing with our money. Repurchased $361 million of shares in Q1 to offset employee equity dilution. Settled $1.5 billion of exchangeable notes maturing in March, fully in cash instead of issuing new equity. End of Q1, 8.8 billion euros in cash and cash equivalents. No debt other than lease liabilities. Management reiterates focus on disciplined capital allocation while maintaining flexibility. So Spotify continues to buy back shares, but does so in order to offset the dilutive effect of gifting employees free shares as compensation, rather than using buybacks as a way to return value to shareholders. The company also paid off $1.5 billion in debt. Despite this, the company maintains a cash balance of 8.8 billion euros. That means Spotify stock with a market cap of around $90 billion currently trades at around 9 times its cash position. Then the company updates us on their pricing strategy. Recent price increases, global in late 2025 and US in January 2026, produced no surprises in churn. Q1 showed no unexpected price-related churn effects. Q2 guidance calls for ARPU growth of 7 to 7.5% year over year, with continued benefits from recent pricing actions partially offset by lapping earlier price moves in some regions. Spotify is experimenting in some markets with structured, good, better, best tiering based on feature sets. Early indications show a structural increase in ARPU where this framework is deployed, though it's still very early and details were not disclosed. Management emphasizes multiple monetization levers across the engagement curve. Free tier for reach and ad monetization. Premium subscription, which is the core ARPU driver. Top-ups, add-ons, e.g. audiobooks for highly engaged users, helping monetize the head of the usage distribution. Like I mentioned earlier in the video, I believe Spotify's pricing power is much stronger than many investors realize. The fact that churn remained as expected suggests there may even be more room for incremental price increases. Then we have commentary on operating expenses and AI investment. Headcount is flat to slightly down. Productivity per employee is rising due to AI and better tooling. Increasing operating expenditures is primarily driven by higher compute usage per employee for AI machine learning development and model training, elevated R&D around AI features and infrastructure, e.g. large personalization models, internal developer tools, increased sales and marketing to raise awareness and usage of newly launched features, productivity tracking, internally measured via code level metrics, pull requests, features completed, definitions of done, and bets shipped. These metrics are said to be growing significantly, often more than 2x rather than incremental. Management describes AI investments as both strategic, upfront model training and infrastructure, and productivity enhancing, faster and cheaper feature development. Q1 and the next 1 to 2 quarters will show a somewhat elevated operating expenditure run rate as AI and marketing investments roll through. Company still expects operating margin to improve on a full year 2026 basis versus 2025. Gross margin and operating margin are both expected to improve in 2026 overall, though quarterly progression will be uneven depending on the timing of investments. So it's good to know that despite rising expenses, both gross and operating margin will be higher on a year-over-year basis. Now, this is the part that caused Spotify stock to fall 12% after earnings. Guidance. Q2 2026 guidance. Monthly active users, 778 million, up 17 million quarter over quarter. Premium subscribers, 299 million, up 6 million quarter over quarter. Growth is expected to be more weighted to the back half of 2026, especially versus a very strong Q2 2025 comparison. Revenue at 4.8 billion euros, up 15% year over year. Gross margin at 33.1%, about 160 basis points above the prior year, balancing core strength with reinvestment in new initiatives. Operating income 630 million euros, reflecting gross margin, elevated marketing for new features, and R&D spending on AI. Full year 2026 expectations, qualitative, continued improvement in gross margin and operating margin versus 2025, meaningful year-over-year growth in free cash flow driven by better profitability and working capital profile, progression toward a normalized tax rate by 2027. Management repeatedly stresses disciplined cost control, even while leaning into AI and new product opportunities. Some of the estimates for Q2 are below what analysts expected. That's why the stock dropped. But in my opinion, this is just short-term noise. Nothing fundamentally is broken within the business. Then we have some commentary on Spotify's role in the wider music industry. Spotify highlights 20 years of building relationships with artists, songwriters, labels, and creators, and claims those relationships are stronger now than ever. Loud and Clear report for 2025. Spotify paid out over $11 billion to rights holders in 2025, a record for the platform. Spotify states it continues to outpace the growth of others in the industry in terms of payouts and expects that performance to continue year over year. New features like Song DNA and About the Song are designed to pull back the curtain on creators and deepen fan-artist connection. Experiential initiatives, e.g. Bad Bunny Tokyo Show and global broadcast, are framed as ways to amplify culture and strengthen the artist-fan bond, supporting retention and platform differentiation. So despite negative headlines and countless anti-Spotify YouTube videos, Spotify is paying serious money to its artists. Then we get some details on the company's employee count. Headcount has been deliberately kept flat or slightly reduced over the last 3 years after prior right-sizing. Leadership highlights a multi-year plan to move Spotify to sustained profitability, with co-CEO Alex cited internally as a driver of that plan. Approach to AI productivity gains is a middle path, not rapidly cutting headcount purely to bank savings, not dramatically expanding headcount. Instead, using AI to do more with roughly the same number of people, shipping more value per employee. So AI is increasing productivity across the business and reducing the need for hiring, leading to increased profitability. So much for all the bearish narratives about AI. Spotify certainly isn't complaining. Next, we have an overview of Spotify's strategic positioning. Spotify frames itself as a technology and R&D company for the music and audio industry, a multi-format, multi-vertical platform. Music, podcasts, audiobooks, video, fitness. A dual revenue model business with ads plus subscription, now supplemented by top-ups. Management believes the company is at a pivotal moment, entering an agentic AI era with new growth vectors and expansion of what Spotify could be. Investor Day on May 21st in New York is positioned as the venue where Spotify will detail this next chapter more comprehensively. Exciting stuff. Now let's get to the part you've been waiting for. Valuation. I'll reveal my updated valuation model for Spotify stock towards the end. On a price to earnings basis, Spotify trades at a trailing 28 times earnings, a forward 27 times earnings, and 23 times 2027's projected earnings. Spotify only became consistently profitable on an earnings per share basis back in 2024. Therefore, from a historic perspective, the price to earnings ratio looks out of whack. If we compare Spotify to a company with a similar business model like Netflix, we can see that the valuation on a price to earnings basis is quite similar, with Netflix trading at 29 times trailing earnings, 28 times forward earnings, and 24 times 2027's projected earnings. On a free cash flow basis, Spotify stock trades at a 4% yield. Then if we look at Netflix stock, it trades at a 3% yield. So Netflix looks slightly more expensive on a free cash flow basis, but not by much. If we look at Spotify's free cash flow yield over time, we can see it's trading at its highest level ever, suggesting that on a free cash flow basis, Spotify stock is the cheapest it's ever been. Now we're going to use the DCF calculator on Qualtrim to estimate the return Spotify stock could provide from today's price. I'm going to use earnings rather than cash flow to value Spotify stock. We have to come up with our own assumptions for Spotify's EPS growth rate over the next 5 years and the appropriate PE multiple for the stock to trade at. Analyst estimates for the next 5 years suggest earnings per share growth of between 12 and 16%. If we use the midpoint of those analyst estimates for our valuation model, it works out as 14% annualized EPS growth over the next 5 years. Just remember that these numbers are very subjective. Then we need to apply an appropriate PE multiple to our valuation model. With 14% EPS growth, expanding margins, and a growing user base, I don't see any reason why Spotify stock couldn't trade at 30 times earnings. So with the assumption that Spotify grows EPS at 14% annualized over the next 5 years and trades at a 30 PE multiple, you could expect the stock to compound at 5% over the next 5 years if bought at today's price of $440 per share. To achieve a 15% compounded return, you'd have to buy the stock for around $280 per share. So from my perspective as a Spotify shareholder, I definitely overpaid for the stock when I bought it back in January. We'd have to see much faster growth with multiple expansion to justify buying at today's price. I'm currently down 20% on my position. I don't think Spotify's earnings were bad, but at this price and with so many other compelling opportunities in the market right now, I'll consider selling Spotify stock and using the cash to add to other positions in my portfolio.